Okay, I'm going to take a look at Hammond Power Solutions, HPS.A on the TSX, $185, about a $1.69 billion market cap, 0.6% dividend. What does Hammond Power do? They are a Canadian company, designs, manufactures, and sells a wide range of transformers. So very cool company. They make Autobots and Decepticons. All right, no, they're electrical transformers, and here's a breakdown of what they do. They're the largest manufacturer of dry type and cast resin transformers in North America. What is a transformer? It's essentially an electrical device that transfers electrical energy between circuits, often stepping up or stepping down voltage. And key products, their products, particularly dry type transformers, are critical equipment for safely moving and distributing electricity from the source, like a power plant or a solar farm, to the end users, like factories, homes, or data centers. And that is kind of key here. Data centers is a key word we're going to talk about. Dry type transformers are often preferred because they are generally safer, more efficient, and more environmentally friendly than traditional oil-filled models. The markets they serve, customers in various sectors, including utilities, OEMs or original equipment manufacturers, and heavy industries in countries like Canada, the United States, Mexico, and India. Some of the trends we've seen, the company's business has seen strong demand in recent years, driven by a global trend towards electrification, electric vehicles, renewable energy projects, and the massive construction of data centers, both of which require significant and reliable power distribution infrastructure. So let's look at Hammond Power over the past 5 years. Tremendous growth here, 3,135% in terms of the share price. If we look back all time, the stock here shows it's up 16,000%. If we go back to our recommendation, we recommended this company before it split out. It's two companies that split, one Hammond Power, one Hammond Manufacturing. Both have done well. We chose to recommend Hammond Power. It has significantly outperformed Hammond Manufacturing, but we're actually looking at Hammond Manufacturing today. Now, tremendous performance. If you go back to when it was 60 cents and it's paid $7, $8 in dividends over time, it's up over 30,000%. Sorry. So what drove the jump about 30% in the share price last week? Well, let's look at the Q3 numbers here. Revenue came in at around $218 million, up around 13.7% from Q3 2024. Adjusted EBITDA was $30 million, an increase of 5.6%, but there was a decrease in gross margins to 30.1% compared to the record high in 2024 in Q3 of 33.8%. The decline in gross margin is mainly a result of higher material costs related to commodity volatility, supply chain inflation, and tariffs. Net earnings increased 6.9% to $17.4 million. Basic earnings per share were $1.46 versus $1.37 in Q3 2024. When you adjust out the foreign exchange losses and share-based compensation expenses, adjusted earnings were $1.56, and we're actually down from $1.80 in Q3 2024. So this is what we kind of call a mixed bag to this point. So what caused that jump, that massive jump in the share price late last week, immediately following the earnings announcement? Well, that would center in around the two items I'm going to list here. The backlog was up 27.7% from the beginning of the year, and there was significant data center project orders booked subsequent to quarter end. Those aren't even listed in that backlog. So if we look at the data center activity here, it's accelerated. Management in their commentary said data center activity accelerated in the quarter end. They were pleased to note that subsequent orders were received shortly after its Q end, amounting to 53% of the Q3 closing backlog, so significant orders. These orders are expected to be shipped primarily in 2026 from their new facilities in Mexico, which will be reconfigured with additional equipment to support this new volume. The backlog growth there, as we said, the company had strong bookings across its business in the quarter, and now outside of that quarter, it was up 27.7%. And again, we said subsequent to the end of the quarter, 53% increase in the closing backlog that were reported almost all from data centers. So that's very significant. Let's look at the current valuations here. PE based on this year's, so 1 quarter out, expected earnings about just under 30. EV to EBITDA based on expected 2025, 18.5. Based on 2026, 24.4. EV to EBITDA based on, and that should say 2026 is 14.6. They're on the higher end, well on the higher end historically, but given the near and midterm growth, they're not completely out of line here. So our quick conclusion, since our original recommendation, Hammond Power has now gained over 30,000%. This quarter in itself was a bit messy after the recent tariffs. Price increases enacted in the spring are working their way through the system, and September's second round is expected to further improve margins in the coming quarters. It'll be blended into Q4, but really into fiscal year 2026, it should drive higher margins. Driving the stock higher last week was management's highly optimistic update on data center growth. The segment is growing much faster than anticipated, with higher quality bookings and more visibility long term. As this trend and recently constructed capacity ramps, margins should expand and produce considerable free cash flow. So clients will be updated on this stock this week, and there's our final disclosures. But definitely Hammond Power is our star of the week, and it's a star of all time for KeyStone clients for sure.
A lot of the time too, or recently in our chat sessions with clients and just elsewhere, I'm hearing so many people, how do we, get a kind of a pick and shovels on AI,
Okay.
And this is a business which, we picked up on, significantly before everyone is asking, where do you find a pick and shovel play on AI? And so something that Ryan didn't discuss as well, that, we spoke about in our 10X webinar in August, is, just the dividend growth on Hammond Power. They had, grown their dividend substantially, where, I believe they're paying almost a 20% effective dividend yield from just a re-recommendation that we made in 2020. And, at that time, Ryan had picked up, the backlog was increasing significantly. We were starting to get clients to, buy more aggressively at that time. If someone bought it in 2020 to today, based on their initial purchase price of about $6 at that time, it was paying like a dividend yield of about 5.6%. Because of the dividend growth so substantial over the last 5 years, on your initial investment, you're making 18% through the dividend on your initial investment every single year, as long as they continue to pay that dividend, which we expect them to, and we expect them to continue to grow it. But very, very powerful story, and not only has the returns been great, the capital gains, but the dividend has been great as well.
Yeah, I mean, what I love to see is, and we hear stories now, I mean, this type of recommendation has changed clients' portfolios, changed their lives. And that's, if you can have a stock that does that, in terms financially change their lives, it may not have improved their mental well-being. Maybe it does, who knows? But it changed their lives, which is great to see. But and it gives you a backdoor way of, and participating in electrification. But we are led to these businesses by the underlying fundamentals. And if it happens to match up to a trend, as we see here, you can get that powerful move. You get, multiple expansion over time. You got growth in the business, and then the multiple expansion comes from people being now suddenly Hammond Power, which was the most boring business for about 20 years of its existence, as we recommended it, is now a sexy story. And, sometimes it's hard to, we had been talking about it being a backbone or a back end way of playing electrification for a decade and a half at least. But it took a long time to get there, and now it's suddenly sexy. I mean, there are fundamentals lead us to other stories. Just 18 months ago, we recommended Argan Inc. as well, which is servicing data centers through one of its areas of business. And that stock has gone from $50 to just under $300 in 18 months. So there are, when is the next? Well, when we're asked that, it doesn't come tomorrow. We're not going to put out, well, I mean, maybe we'll find a company in this week and we'll come out with a recommendation. It can happen. But, we're constantly scouring the markets because what you want is high quality businesses. And like when we bought and recommended Argan, almost, 30-40% of its market cap was in cash. Good dividend at that point, and then good growth in earnings, and that its backlog has, like we're seeing with Hammond Power, backlog's absolutely surged, and we expected it to go higher. It's gone higher than we had even expected, which is always great. But those are the type of businesses you want to buy. Take a good bet on the existing business being undervalued, and if they can find some growth tailwinds, you really can get a tremendous uptick in terms of where the share price can go long term. Good fundamentals in a business lead you, and if you're powered, combine that with a trend. I mean, you can see the trend, but it doesn't always come to fruition. But you want to have a business that, if people weren't using gas-fired plants that Argan uses to help power data centers, if people went in another direction, this company had other areas of its business that can justify the price that we're paying for it. So we're not seeing, a company like when we talk about junior mining companies, if that junior mining company you bought at $2 doesn't find what it's looking for, that company can go to 10 cents. So if Argan didn't find a huge tailwind in one of its segments, gas-fired plants that are servicing data centers, electrification, all of that, its business doesn't collapse from $50 to 5 cents or to $1 because it has other parts of the business that are growing and had a strong backlog. Plus, it had a great balance sheet as well. So you want to limit your downside and give yourself the upside and do it smartly. And that's what we're trying to do over time.
Yeah, the way
Again,
I
my
see
soapbox.
Yeah, the way I see that, just to give another perspective from that, is effectively you get a free call option on data centers.
Yes.
That's how I would put that.
Yeah, for sure. And that was a lot simpler.
Yeah,
so
exactly.
Yeah, there you go. No, and that's true. You're getting that optionality, the upside in the business. And you buy a core business that if you don't, it's free because you've already got this asset sitting there that if it does not come to fruition, maybe you have good growth, 5, 10, 20%. You don't get 30,000%, but you still get good growth, but the downside isn't there. And that's one of our jobs as well, to look at companies that we can limit the downside in. And that's why we're very selective.
But before we move on to, I just kind of want to tell a little bit of a funny story. So we're interviewing companies. This is a little while ago, and I won't say what company that we're interviewing. But it's an
Let's
EV.
See if me and Brett can guess, right?
Well, you guys will know. I know Brett will know for sure. But it was an EV charging business. We're going through the interview, and at the end of the interview, Ryan asks, "Do you use Hammond Power transformers? For your EV chargers?" And the CEO of the company said, "I don't know." And Ryan proceeded to say, "Yeah, well, in fact, you do use Hammond.
You probably
Hammond Power
should know
transformers."
Yes. Yeah.
So it was the CEO was a little taken back that Ryan knew this. But anyways,
I was taken back that he didn't. That's what it's.
Yes, that's true. But anyways, me and Brett had a little bit of a chuckle after. Yeah.
I did not mean it in any negative way. I just thought we'd have a conversation about it, and I was surprisrised that he didn't. Yeah.
Yes. Anyways, sorry.
We're not naming names.
Such an under the radar company that even the CEOs don't know exists.
Yeah.
So there you go.
True.
Yes.
But yeah, it's fun. It's funny. Major is one of the biggest companies in their segment. Hammond has a bigger market cap, and I went back because as you were talking, I was looking all time on Major Drilling. It's far more like this and straight across basically, but I mean they are up say 400% all time. But you look at like Hammond Power. Hammond Power. If you go back, that's basically the best performing stock in Canada over that time. And there's not many stocks that have got up 300x or 30,000+%. Right?
Yeah, weird to say, isn't it?
Yeah.
Yes, it doesn't come out of the mouth easily because it's like that type of return doesn't make. Yeah, you just don't see it. It's fairly unicornish.